Retail is frantically panic selling, assuming the AI storage supercycle is cooked. Western Digital has been in a total bloodbath over the last 2 weeks, shredding over 30% of its market cap as the equity violently rolled over from its high down to $539. Chasers are screaming that the smart money is completely rotating out. But if you audit the microstructure, this steep markdown was triggered by 2 specific catalysts that top analyst desks argue are being wildly overblown by algorithms. Let's check Thursday's tape. WDC closed out down a heavy 9.92% on the session, wrapping up at $539. Shaving off a third of your valuation right after printing fresh macro highs looks devastating on a linear chart. But are the business fundamentals actually broken? Let's run the numbers. Before we dissect this hardware consolidation, smash that like button and subscribe. If you want to front-run institutional block trades, automated options flow, and global tech rotations, click the link in the description to join our private desk. The first structural headwind was the Meta headline. Rumors that Zuck plans to lease out excess AI compute caps triggered a massive sector-wide flush across the entire hardware stack. Bears assume that if compute goes efficient, hyperscaler Capex and high-capacity storage orders are hitting a cliff. But that's a completely flawed read on cloud infrastructure economics. Meta isn't dialing back its AI blueprint. They are optimizing underutilized clusters to drive margin efficiency. This is the exact playbook Amazon used to turn internal server overhead into a WS. It validates long-term scaling. It doesn't dismantle it. Elite buy-side desks are focusing on the elasticity curve when the marginal cost of computing power collapses. Aggregate enterprise adoption scales exponentially. Lower execution friction means more complex LLMs, massive data ingestion pipelines, and structural demand for dense SSDs. The second panic factor was the macro headline out of Seoul announcing massive state-backed semi-cap allocations. Retail immediately priced in a severe structural supply glut and subsequent chip price collapse. But they forget that fab construction to volume commercialization takes a 5 to 10-year lead time. The market is aggressively discounting 2026 equity prices based on hypothetical supply sheets that won't hit the physical tape until 2030. This is a pure sentiment-driven leverage. Flush the technical algorithms are trading headline momentum while completely decoupling from current fundamental data. On the physical side, the enterprise matrix remains incredibly tight. Hyperscalers are aggressively hoarding wafer supply to prioritize HBM, squeezing legacy NAND capacity. Samsung is hiking contract prices. SK Hynix is locking down 5-year allocations, and Micron's prints are rock solid. Retail still views Western Digital as a legacy HDD manufacturer, but the institutional investment thesis relies entirely on its enterprise, NAND, and high-density storage layers. GPUs handle raw compute, but you cannot train or run inference on multi-trillion parameter models without massive data retention pools. Near-term delta volatility is bound to stay elevated after a massive macro run, and local profit-taking is standard tape mechanics. When the primary industry fundamentals are intact, an aggressive drawdown like this is a compression of the forward multiple, not an operational collapse. Checking the Bloomberg terminals, Wall Street consensus shows a highly fractured target spread spanning a conservative $450 floor to an ultra-bullish $1,050 ceiling, averaging near $655. The smart money is letting the retail float panic while they audit the underlying data center expansion. Let's stress test your conviction. Is this 30% markdown a toxic warning sign that the tech trade is officially rolling over? Or is this the ultimate local bottom to scale into premium semi-blocks? Hit the notification bell, subscribe, and lock in your precise tactical thesis below. See ya!